Welcome to the Investing Show. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got Lucy MacDonald of Brunner Investment Trust and Richard Hunter of Wilson King.
Simon.
Lucy, Brunner Investment Trust is what the AIC call a dividend hero.
That's
it's
right.
raised its dividend now for, I think, 45 years in a row, is that correct?
That's absolutely right.
But the history goes back quite a bit longer than that, doesn't it, as it does with many investment trusts. Can you tell us a little bit about that, please?
Yes, it goes back to 1928. It was a chemical company called Brunner, which was sold to ICI, and the proceeds of that, came to make the trust. And the family is still a shareholder, so of all of that time, they've been involved, and their involvement is still important because the objective of the trust to grow the dividend in real terms is something that they're much in favour of.
And things have changed slightly in those 90 years, haven't they?
They certainly have.
What's the Trust's outlook today? What do you go looking for when you're investing?
Well, to get that objective of real income growth, you've got to have both yield and some capital return. And so we have a preference for companies which can grow, who are in growing industries, and have the ability to really get the top line moving through their own innovation. So those are the sort of companies we're interested in. But at the same time, we need some companies in there which are also got decent yields, which can keep the core part of the dividend coming through. And what we've done over the last few years is to get some more exposure to overseas, both for capital and for income. I took over the full management of the trust 2 years ago, and at that time we felt that the income generation was too dependent on the UK. And so there are quite a few solid, dependable, but not necessarily growing companies in there, in some of the banks, the pharmaceuticals, in energy. And the dividend cover on those names was not very high, and the dependence on the trust for paying the dividend on those companies was very high. So we felt the right thing to do was to diversify those sources of income, but also give some more exposure to some more interesting growth companies overseas. And so we've shifted the trust in the last couple of years to have more overseas. And
do you still hold the same different number of companies, or have you trimmed that down as well?
We've consolidated to some extent. I've always run concentrated portfolios, and I think it concentrates the mind and generates the alpha as long as you pick the right stocks. And so that's how I'm comfortable. The other funds that I run are similar. And so we're now around 80 stocks. And I think it does mean that all the work that we're doing to find and make the right decisions about the stocks does merit having a decent weighting in them.
Is it fair to say that there are certain overseas markets, I'm thinking of the States in particular, but maybe in Europe as well, where they just haven't got the same interest or attitude to dividends that we have in terms of the yield, which presumably makes it a bit more difficult for you to be searching?
In the US, that's true, although it's changing in some areas like technology, where a few years ago there were no dividends, but now in a company like Apple or Microsoft, they're both paying dividends, and they've got the cover to be able to pay more. So I think that's an area in the States where there's more potential for dividend. I think financials as well in the US and elsewhere, having gone through a financial crisis, had to, in some cases, stop paying dividends completely, now coming back to the dividend list, and so there's more potential there. And then outside the UK, Europe's a big dividend payer, and so is Asia. So I think it's really only the US that's just, and parts of the US, which it's still not the main focus.
And how do you balance that sort of hunt for the dividends that companies can pay with the growth that you were talking about earlier? Because I was having this conversation with someone the other day, and they were actually talking about investing their own money, and they were looking really for income. But they said to me, but of course, maybe it's better to go for a bit of growth and for me to spend a bit of that capital than it is to just go hunting for income for the sake of hunting for income.
Well, it depends how strong our own dividend cover is from the companies that we own to start off with. So once the dividend is safely covered, then we can go and be more adventurous. And that's what's really happened in the last few years, is that our position is strong. We've got good reserves, and we can pay the dividend. And Also, we have some quite expensive debentures which are maturing, one of them in January, which gives us a bit more flexibility as well. So it really comes down to, are we covering that dividend well and sure that we can keep that objective of growing it, and then we can go out and be more adventurous.
And do you look at sectors, at countries, or do you go looking for individual companies and really try and get under the skin of those companies? What point do you start in the investment process?
We look at companies, and we are in a concentrated portfolio. You have to really make sure that you're picking the right stocks, and that's what's going to make a big difference. And over the last couple of years, the improvement in performance that we've had is really down to improving stock selection in the UK in particular. In the overseas part has always been relatively strong, but the UK was slightly weaker, so we've improved the stock selection there. And also at the same time, we have managed to get our stocks and country positioning right too, but that is a smaller part of the overall risk and return than the stocks. It really is stocks first, and then adjust the portfolio to make sure that we are we haven't got unintended risk in there.
You mentioned Asia as a potential investment destination. Is there one kind of sector or type of stock which keeps presenting itself as an opportunity in the likes of China, for example?
Well, there is both growth and income available, and so we have some Chinese stocks there for income, and then a company like Tencent, which is there purely for growth. And I think as we go forward, we are going to find more potential in China. There's a lot of company formation. Things which have been holding us back in the past of quality is improving. Governance is still below where we'd like to see it, but is moving in the right direction. So I think it's an area where in the future we will have more exposure.
And when you go looking for the companies, are there any particular attributes that you look for in those individual companies that makes you think, yes, actually this is the kind of company that can deliver year in, year out, and I want to invest in?
Top line growth is always a good starting point, but it's the quality of the returns within the business which is of a great interest to us. So what we're looking for is sustainability of returns, and that's sort of through time, and margins, return on assets, and the ability to allocate capital well. So, what have they done with the surplus capital that's been generated in the business? Have they bought other businesses well? Have they invested well in the business? And then the management themselves, have they had a decent duration? Have they been responsible for these decisions which have been successful? And how are they motivated? What is their remuneration based on? Is it aligned with our own? So these are all things that we're looking for. And then, when all of these attractive things have been identified, we look at the valuation and say, well, has everybody else sort of known this for years and therefore it's all in the price, or is there some potential upside? So I think that's really what we're looking for. Now, where we are at the moment, I think it's a very interesting time because of this big digital move that we're seeing really going through all industries, which is raising more question marks about the sustainability of some of the returns in these industries. And I think that probably means higher discount rates should be associated with some companies in particular, some industries, and probably associated with the time they are in this move through digitalisation. I mean, there's going to be a period where there's a lot of uncertainty about how the returns in an industry will survive. And then as it moves through that, it will become clear whether the barriers to entry are holding up or not, and whether the competitive positioning in that industry is staying stable or whether it's changing, whether the barriers have come down to allow new competitors in which case the returns will be probably coming down. So I think there's a lot more debate now about sustainability of returns as we move through this digitalisation phase, which could last for decades.
And I read a few company reports. I imagine that you read many, many more company reports than I do. But it seems to me that there's still now this bit where companies have this little bit digital strategy that they just slot somewhere into the company report, or they think they should mention it at the AGM, or maybe as part of the investor presentation. And it's almost as if they're just, often some of them, it feels like they're just ticking a box. Someone went, oh, you better mention the digital strategy.
Well, I think
you presumably, actually what you want is companies where that isn't just stuffed away in a bit in the market,
It's
in
right
the
there in the
report.
centre.
It's they're making it front and centre of what they're doing.
I think you're absolutely right. And the basis, they have to start, talking about it, but not just talking about it, but doing it. And the doing is the more interesting thing. But I think by the talking about it, you get an idea about whether they've got an idea of what it is they're doing. But it really needs to be absolutely central. It needs to be in the board. It needs to be in the executive who understand it, or at least have access to people who really do understand what to be doing, and to be moving ahead, investing sensibly. And to be looking at different options of what investments they could be making. Do they need to make it themselves? Do they joint venture with someone? Is there another platform that they could be using? And these are the debates that we want them to be having internally and then having externally. Now, the interesting thing as they move through that is that it could affect their reported numbers quite severely, because a lot of these investments are taken upfront against profits. Traditionally they would have been, described as capex, investing in new assets. But the assets that they will be investing in are digital assets, which are generally not on the balance sheet. They could be software, they can be platforms, and then there's the investment in digitalisation, their existing assets, and then there's enabling their staff to be able to manage these digital tools. None of that is going to be very clear in the reported accounts. And I think particularly that the part about staff and how we measure what the value of these staff is from the outside is going to require quite a lot more work, because there are some staff who are going to be highly valuable at generating assets, and there are others who are going to be, at any moment could be automated out of their roles. And being able to see and understand whether the investment's being made in the right areas and what's happening with the people in the business is going to be very difficult to see from the outside. But those are the conversations that we will be having with companies who I think are beginning to have them with themselves at the moment. So it's a very interesting time for being able to analyse, and I think it will give a lot of opportunities to active investors. Because this is not going to be at all clear, even to the active investors. So for those standing back and not even trying, I think it's going to that you're going to be missing something. There are going to be a lot of opportunities coming through this, both of winners and losers, and those who are unclear at the moment, but will be becoming clearer over time.
So in your experience, would you find it more interesting to maybe look at a pure digital play, or maybe an established name which is making that transition to have that as a core part of their business?
I think we'll probably want both. And some of the pure digital, players are in some ways easier to understand now because they are more established and they've got the revenues and they have now mostly got some margin as well. But those that are more hybrid and moving, online are more challenging to analyse, but could be quite interesting over time because they could be undervalued. And there are companies like Microsoft, and when we invested in it, looked like a dinosaur from the outside, but we could see that they were beginning to invest in cloud, and now Azure is a significant part of their business, and they are sort of moved themselves into the growth and the survivors place. Well, those are the companies which are interesting, because that's had, as well as a growth acceleration, has had a valuation upside to it as well. And that's the sort of thing that we'd like to see. So more of those. I think Accenture really comes into that as well. There are a few companies within the consumer space which are moving online. I think some of the Adidas, Nike are sort of moving more online now and going direct. Well, that will have a beneficial impact on their margin. So I think there's plenty of companies which are going through this phase at the moment, and analysing them well and seeing which are really beginning to get it right and getting some traction, and that's not yet recognised. I think that those will be interesting opportunities.
And presumably that work that they put in now is the kind of thing that's going to mean that in the future they'll be able to not only grow their business but also pay you a better dividend.
That's absolutely right. Yeah, so they will be able to grow, and also they should, once they've gone through the initial real setup, investment phase of getting them, shifting themselves online, and then as they go through time and be able to close down more of their legacy business, then that should improve their cash flows as well, and therefore be able to pay more of a dividend out.
That's all we've got time for, I'm afraid. Thank you very much for joining us.
Brilliant.
Richard, thank you very much for joining us.
Pleasure.
Thank you very much for watching. Join us next time on The Investing Show. Goodbye.